Hi, it's Larry Gaines, Power Cycle Trading. This week I've been doing a series on the free option tools that you get with any brokerage platform. And if you're able to utilize those tools, they can really provide you a lot of great market information. Such as option delta, what that can do for you, the theta, gamma, implied volatility. So what I wanted to do is cover implied volatility in this video today. And basically we'll start off with what is implied volatility. Well, it's what the marketplace is implying the volatility of the stock will be in the future based on price changes in an option and then calculated based on using an option pricing model. The implied volatility, it's a forward-looking measure and it differs from historical volatility because historical volatility is calculated from known past returns. So the cool thing about implied volatility is that it's basing its future price prediction on what's happening currently. So I'm going to show you a couple examples that you can use and take advantage of implied volatility, because let's say the market's going down real hard and that volatility pumps up and goes high, but then what happens when the market goes sideways and stabilizes? Well, you still have kind of a lift on implied volatility, and this gives you the opportunity to take advantage of implied volatility if you understand the tool and how to use it. So I'll show you a couple examples here. This is TAN, and this is the ETF for the solar sector, and it's had a really huge move to the upside, as you can see, and the last few days it's been selling off pretty hard. So you can see here the yellow line here is your implied volatility, and that blue line is your historic volatility. So you can see how that volatility has spiked. Now, when the volatility spikes, it's usually on a down market. That creates a little bit more volatility. But what can happen is if this market starts to go sideways, then it gives you opportunity to take advantage of that implied volatility, the spike, which creates higher premiums. So you might want to take advantage of it by maybe selling some kind of option credit spreads, perhaps a bull put credit spread. You might even be able to sell a call credit spread. So here's another example. Here's Google. Now, you can see Google here, and it's had a big move down into the 50 moving average. The implied volatility spiked. Now it's up to about 60% versus where historic volatility usually is. Now what you can do is maybe if this holds in the 50 moving average range, then it gives you an opportunity to take advantage of the volatility spike by selling bull put credit spreads out of the money. So you might look at selling something like it's trading 1172 right now, selling something out of the money at, this is just a what if, at 1137.5, buying the 1132.5 put, so that's a bull put credit spread, $500 spread. Collect 60 cents, maybe 70 cents, that's $60, $70. And that's a weekly option expiring this coming Friday, so this could give you a return of over 13%. And that's by taking advantage of implied volatility. Hope this helps. Talk to you on the next video. Almost forgot. I'm doing a free webinar on option tools you can use tomorrow to lower risk while increasing your returns. Now this will be this Monday night at 6 p.m. Central. So if you'd like to get in on this free webinar to learn more about the option tools that are free, just register here from the link that's provided on this video or the link on this email that you received. And join now because these things fill up fast. Thank you.